Okay, so let's get into this because what happened with Wipro's latest earnings report is, well, it's a real head scratcher. On the surface, some of the numbers looked pretty decent, but the company's stock took a serious nosedive. So, what on earth really happened? Let's break it down.
So here's the big question, the one that doesn't seem to make any sense, right? We're always told that when a company's sales go up, its stock should too. But in this case, revenue grew and the stock just tanks by over 7%. That kind of mismatch is a huge signal that the real story isn't in the headline.
And to figure this whole thing out, we've got to look past those big, flashy headlines. This is really a tale of two very different numbers, and each one is telling a completely different story about how the company is really doing. And boom, here they are, right next to each other. On the left, you see the good news everyone was talking about. Revenue was up. Looks pretty solid, doesn't it? But then you look to the right, and oof, the bad news. Profit was actually down, and not by a little bit. This is our first major clue. It tells us that even though Wipro was bringing in more money, it was costing them more to do it, and they were keeping less of it. But you know, a dip in profit, that's not even the whole story. Not by a long shot. To really get why the market freaked out, we have to put on our analyst hats for a second and dig one level deeper. The key that unlocks this whole puzzle is a term that sounds kinda technical: constant currency growth. But the idea is actually super simple. It's a way to filter out all the noise from global currency rates changing all the time. It shows you how much the business actually grew because people wanted their services. It's basically the company's true health check. And this chart? Man, it says it all. You see that 3.8% growth that was reported? Well, once you strip out those currency benefits, the real growth, the underlying demand, was only 1.4%. That is a huge difference. It told investors that a big piece of Wipro's so-called growth wasn't from winning new business. It was just an illusion created by a favorable exchange rate. Okay, but this is where things went from just kind of concerning to really bad. Because here's the thing about the stock market. It's a forward-looking beast. It cares way more about what you're going to do than what you just did. And what Wipro said about the future, that was the final nail in the coffin. And there it is. Wipro told the market to expect 0 to 2% growth for the next quarter. In the high-speed world of tech, that's like basically hitting the brakes. For investors, this was the ultimate red flag. It signaled that Wipro's own leadership doesn't see things getting better anytime soon. This is what really sent the stock tumbling. And it wasn't just that one number. Once investors got spooked, they started looking around, and yeah, they found plenty of other signs that backed up this gloomy outlook for the company's future. So, take a look at their booking numbers. Bookings are just new deals they signed, right? They're the best crystal ball we have for what future revenue is going to look like. And as you can see, both their total deals and their big chunky deals were down compared to last year. That's a bad sign. It means the pipeline of future work is getting smaller. And this weakness wasn't just a problem in one little corner of the company. When you look across their different business areas, you see that some key sectors like energy and manufacturing actually went backward. This showed investors that the challenges were pretty widespread, which just added more fuel to the fire. All right, now let's be fair here. It wasn't all doom and gloom. In any big, complex report like this, there are always a few bright spots, and you've got to look at the whole picture. I mean, the company was actually running pretty well on the inside. They were generating a lot of cash, and they were really good at turning their profits into actual cash in the bank. Plus, fewer employees were leaving, which is always a good sign of a stable company. These are all signs of really disciplined management. But is that what really moves the needle for investors? And that's really the heart of it. Being disciplined, being efficient, that's great. It's commendable. But for the market, for investors looking to make a return, it all comes down to one thing, and that's growth. Without a clear story for how you're going to grow in the future, even a well-run ship is just sitting dead in the water. Okay, so we've waded through all the numbers, the good, the bad, and the ugly. What's the big takeaway here? How should we think about this, and what can we learn from it for the next time? Here's a super simple framework. First, always look past that headline revenue number. Second, focus on the future. What the company says it's going to do and the new deals it's signing, those are your best clues. And finally, understand the context. In this case, that weak guidance screamed slow recovery, and that's the real reason a stock got hammered. So what's the game plan now? Well, in the short term, the message is pretty clear. Be cautious. The signals for growth just aren't there yet. For the long term, folks, it's really a wait and see situation. You have to watch for a real turnaround in those forward looking numbers we just talked about, stronger guidance, and a rebound in those bookings. And that really leaves us with the $1 million question, doesn't it? In this tough environment, what's it actually going to take for Wipro to get its growth mojo back and get the market excited again? That's the story we'll all be watching in the quarters to come.